Welcome, everyone. Appreciate your attendance. I think we'll get started now. My name is Bill Gelbach. I'm an enrolled tax agent, and I'm also the co-chair of the Pasco Hernando chapter of SCORE. And we're going to talk today about some tax strategies and some ideas that might help you as an individual proprietor with your taxes. First, I'd like to talk a little bit about SCORE. Just for a few minutes, talk about our mission and vision and kind of what we do as SCORE. SCORE has been around for a long time, as the slide says. Was formed in 1964. We are a resource partner for the Small Business Administration. We're not part of the SBA, but we work with them and they provide us some funding. But the majority of people that work with SCORE are all volunteers. Throughout the history of SCORE, we've been able to help over 11 million people with their business. And our mission is really to help small businesses and to provide the mentoring and education to help those businesses flourish. And we really believe that our vision is that anybody that needs support with their business can get it, and that they have the resources available and the information available for them to be successful. And our real belief, and I know all the volunteers I work with, is that if the clients are successful, then we're successful. So that's something that we all pay a lot of attention to, and it's kind of the core thing that drives us. What do we do? Well, we provide free business advice and mentoring. That's one of the key things that we do. Just so you know, if you're interested in getting a mentor in the future to help you with your business, just go to either our national website at score.org or the pascohernando.score.org chapter, our chapter website, and you can ask to have a mentor assigned to you. And that mentor will be able to, provide advice and help you with your business. We also offer low cost or no cost business training. Here's an example of the no cost business training. We offer a number of webinars from our chapter every month. Other chapters in the area also offer webinars, and there's a number of things like that are available at a national level from our national website. So there's a lot of free information available from SCORE to help you in various areas of your business. We also have libraries with templates and other resources that can also be helpful. So we try and provide a fairly broad spectrum of things to help businesses. And like I said, most all of this is free. So something you can take advantage of. Who we are, there's over 10,000 volunteers nationwide. We're serving over 1,500 communities. And as I said, the key is these are all volunteers. These are people that have been in business and are willing to share some of their expertise with those who either are in business or want to be in business. So just kind of blow our own horn a little bit. Last year, we track a lot of statistics, but last year in SCORE as a national level, we actually were responsible for working with people to create over 45,000 new businesses. That resulted in about 75,000 new jobs for non-owners. And if you include all the owners, it was a total of almost 120,000 jobs. So SCORE does have a reasonable impact on our local communities and at a national level. So let's talk about what we're going to cover today. Talk a little bit about, basically talk about kinds of deductions that might be maybe you're already aware about or maybe not, but the purpose of these deductions is to help reduce the taxable net income from your business and potentially save you on both your income tax and your self-employment tax. So we're going to talk about gifts that you can give and deduct. Talk about some vehicle expenses, make sure you understand what you can and can't do relative to vehicle expenses. Talk about home office deduction, which can often be a big benefit for new business people. talk a little bit about retirement plans. One, it's important that you think about that, because if you're in business for yourself, you may even not be putting as much into Social Security as you might have if you were employed by somebody. And it's something that you want to think about. But the other real reason is that if you have money that you want to put away, you can put it away tax-free in retirement plans for small businesses. And I'll introduce you to a couple of plans, but that'll basically allow you to put away a lot more money than you could as an individual. We'll talk a little bit about entity-related considerations. Why are you, what type of business are you? Are you a partnership or a sole proprietor or an S corporation? And what might be the tax advantages or reasons you might want to consider one form of business over another? And finally, we'll talk a little bit about estimated taxes, since this is kind of geared towards individual business people. If you're not paying yourself a salary, then you need to be considering paying estimated taxes to avoid having any underpayment penalties at the end of the year. So we'll touch on that as well. First, let's talk about the $25 rule. I don't know, depending on your business, you may like to give away, you may like to give gifts to your clients, and that's okay. You can give a gift of basically any amount, but only $25 of that is deductible on your taxes, per gift per client. And if both you and your wife give something to a client, then it's got to be the combined amount of those gifts can only be $25. You are, however, allowed to give away and deduct just little personal items under $4. If you've got little giveaways that have your business name on, business logo, you can pretty much give away as much of that as you want and have that be deductible. If one of your clients is a business and you want to give, say you want to take a basket of food basket or something like that, and you want to give a gift basket to a business at the end of the year, there are no limitations on giving gifts to a business. Only the limitations are only giving gifts to individuals for them to be deductible. $75 rule really deals with receipts. It's important to keep receipts, but the IRS doesn't require that you have receipts available if the expenditure is under $75. You do kind of have to be able to justify what you expensed and have some kind of a log as to what you did in terms of how much you paid, who you paid it to. So I always recommend that you just keep the receipts. That's the easiest way to have a log of and to write on them what that expense was for. I know a lot of this seems very picky, but if you're ever involved in a business audit, you'll find that the IRS is looking for way more detail than you ever thought possible. So you want to keep as good a records as you can, and especially with business expenses, because these are the things that they will pick on. Another thing is you want to make sure you separate your business and personal expenses. For instance, you go to Home Depot to buy something for your business, and you also pick up a couple of things for your home. You don't want to put those on the same receipt. Get them to do separate receipts. So you have a receipt for the business stuff and a receipt for the personal stuff. And that way it's much clearer and much easier to justify those expenses. So keeping receipts, I think, is important. And I think regardless of the IRS regulations, I think it's important to keep all your business receipts and to keep them in some reasonable form. Let's talk now about vehicle expenses. Vehicle expenses tend to be one of the biggest items of deduction on a lot of individual business people's tax returns. As a result of that, it's also one of the things that the IRS likes to pick on initially in an audit. So understanding how to do this and what counts and what doesn't count towards business expenses is important. And keeping records about your business mileage vehicle expenses is also important because they can be pretty demanding about what it is you need to provide to justify those vehicle expenses. There's two ways to deduct vehicle expenses. One is the actual expense method, where you're going to deduct all the individual expenses associated with operating your vehicle. And the other is is what they call a standard mileage rate. And we'll talk about that in a second. So actual expenses, you can deduct basically anything that's associated with the operation of your vehicle for business purposes. Gas, and you can deduct all your gas, obviously, any oil changes, repairs, maintenance, tires, insurance, all of these kinds of things on the slide. You know, if you're, for instance, you're doing Lyft or Uber and you need to keep your car clean, you can deduct the washing and detailing of your car. So any of related expenses. You can also depreciate the vehicle, which gives you some additional deductions. And if you happen to be leasing the vehicle for your business, you can actually deduct the lease payment. If it's a personally owned car, you can deduct excuse me, interest that you pay on loan. But if it's a lease vehicle, you can deduct the entire lease payment. All of these are subject to what they call business use percentage. If you're using the vehicle part personal and part business, you can only deduct enough of these expenses for the business part of it. And the way that's determined is by taking the total number of mileage that you drove for the year and dividing that into the total number of business miles. Say, for instance, you drove 20,000 miles total for the year. And $18,000 of that, or 18,000 miles of that rather, was business mileage. So you now have 18/20ths of your mileage, or 9/10ths of your mileage, or 90% of your mileage was business mileage. So you get to deduct then 90% of all of these vehicle expenses, which is a good deal. Or the other option is that you can use a standard mileage rate. The standard mileage rate last year was 56 cents a mile. And for 2022, there's actually two of them. The first 6 months of the year, the standard mileage rate was 18.5 cents a mile. And for the second half of the year, the standard mileage rate is 62.5 cents. That's inflation. So the other option with your 18,000 business miles is just to multiply that 18,000 miles by either 58.5 or 62.5, depending on when you took those miles. And so your question is, which one should I pick? Well, the obvious answer is you pick the biggest one. Whichever one of these two methods gives you the best deductions. And many times, depending on the mileage you drive and how it works, many times the actual mileage is the better one, because you get to include depreciation and other things that aren't really taken into account in the standard mileage rate. So that's often the case. The best thing to do is the person doing your taxes, have them look at it both ways and see which one is going to be the best for you. You're allowed to pick whichever one is going to give you the largest deduction. A couple more things about standard mileage rate. If the first year you use the vehicle in business, you choose to use the standard mileage rate, then in subsequent years, you're allowed to change. You could go, you could switch to actuals in a subsequent year if that happened to be beneficial for you. But if you start the first year with that vehicle in business, you start using actual expenses, you have to continue to use actual expenses for the remainder of the time that you're using that vehicle for business. Another thing about leasing is that if you lease a vehicle and you start with standard mileage, you have to use standard mileage for the remainder of the lease period. You can't, with a lease vehicle, you can't switch back and forth. And that's because in reality, the actuals involve depreciation, and you can't rather depreciate a lease vehicle. It's not yours. So what mileage can you deduct? This is a question that always comes up, and people want to deduct all possible mileage that they drove. And and you can't. There are some specific things that you can deduct and some things that you can't. Tried to show that on a picture here. Say, for instance, you're going from your home and you've got an office that you work out of, a place where you conduct your business. The trip from your home and back is considered commuting, and that's not deductible as a business expense. Also, say you travel, happens with like real estate agents, for instance, they may have an office, they may travel from their home to see a client at one of their properties, and then they may go to another client. Maybe they drop by their office, they go to a municipal facility to file some papers, or then they go see another client's home and then they go home. Well, the first trip, in that case, the first trip from your home to a client's location is also considered commuting, and that's not deductible. Any of the trips in between that first client and your last client, all those mileage is deductible. And the final trip home from your last client to home is also considered commuting. So you got to kind of keep track of where you're going and what you're doing. And the key to deducting these business miles is tracking all the mileage. The IRS expects you to maintain what they call a contemporaneous log. That's a log that's you've done as you incurred the mileage. It's not something you try to make up at the end of the year. And you need to be able to, you also need to be able to prove the total number of mileage that you drove. So best thing to do at the beginning of the year, record the odometer reading on your vehicle. At the end of the year, record the odometer reading, and that way you can capture the total mileage. Then also need to track each of the individual business trips so we can add up and calculate the total business mileage. And again, the business mileage divided by the total mileage calculates that business use percentage. So you need to keep that total mileage and you need to log the business trips. And ultimately, you need to be able to prove that you actually drove that number of business miles. I had an audit. Fellow had been audited once before. Unfortunately, he kept really good records, but the IRS also wanted him to prove that he also drove this 60,000 business miles that he was claiming. So how do you do that? Well, best thing to do is if you take your car in the beginning of the year and get it serviced, the receipt you get from the service garage usually has the odometer reading. And then you do the same thing at the end of the year, you've got a receipt that shows the odometer reading there. And if the difference between those readings is at least the number of miles that you're claiming, then you have proof that you actually spent those miles. And that's what we ended up doing in this audit. We found a receipt from March of the tax year and another receipt from the following February, but the mileage difference was large enough to account for all the miles that we were claiming. So I know that seems really picky, but if you get audited, that's exactly the kind of information that you need to be able to provide. So I'm just letting you know, it's good to keep plenty of records when it comes to claiming vehicle mileage. And same thing with expenses. If you're buying tires or getting a car serviced or getting a car detailed, again, you want to have receipts to justify that. There are a number of, I just got this off the internet the other day. If you just Google, vehicle mileage apps, you'll find dozens of these. This is just one snapshot of one website I found that shows various applications that help you track mileage. And these things are pretty smart. They're smart enough to recognize that they're using GPS. They're smart enough to recognize that your phone is moving fast enough that it's probably in a vehicle. So that it's smart enough to know that you're taking a trip. And then you have the ability to annotate with that trip, whether that was a business or a personal trip. And you can enter some notes about who you saw and what you were doing. And so it gives you a way to keep a nice complete record of what you're doing. So you may want to look into one of these. I've had some experience with MileIQ. That was one of the early ones, but now there's quite a few. And if you're using QuickBooks, they have one that just integrates directly with their software. Initially, some of these were free. Looks like a lot of these now have at least some monthly fee for using them. But if you're doing a lot of traveling and that's part of your business, you really might want to look into one of these, because it's the best way I know to keep a complete record of your business mileage, and that's important. Let's talk a minute about leasing. Question is, should I lease a car or should I buy a car for my business? Well, and there's some pros to leasing. Obvious ones, reason people lease is because you can get more car for less money, or get newer cars more often for less money. Because in reality, with a lease, you're financing the difference between the initial value of the car and its value at the end of the lease period. So you're financing a smaller amount over the term of the lease. And you can deduct the lease payment as a business expense, not just the amount of interest that you're paying if you were paying off a loan. So you can potentially get a bigger deduction. The drawback to leasing is that there are mileage limits on most leases. The longer you make that mileage, the higher you try and move up that mileage limit, the bigger the lease payment's going to be. Reason is that the more miles on the car, the less its value at the end of the lease term, so the larger amount that you have to finance. And there's often upfront cash. So this is again a trade-off. There's not an absolute answer, leasing over buying. Something you need to look at. If you're not driving a lot of miles, maybe a lease is a good deal. If you're driving a lot of miles, maybe it isn't. Again, these are things that working with a tax professional, they can help you understanding the vehicle expenses, the type of deductions to take, and they can help you make decisions about leasing versus buying. A couple more things about vehicles. Normal passenger cars and light trucks have some limitations on the depreciation. But if you get into a vehicle where the gross vehicle weight is over 6,000 pounds, a lot of those deductions change. In fact, in 2022, you can deduct 100% of the cost of a vehicle that you buy. So you buy a new Chevy Tahoe for your business and pay 50 grand for it, you can deduct the whole $50,000. And this is, interestingly, it used to only be new vehicles. They changed that law a couple of years ago, that now that this what they call bonus depreciation also is good for used vehicles as well. But there are some restrictions on the used vehicles. They have to be, you can't have used them prior. In other words, you can't take your Tahoe that you've used personally and then start using it and say it's your business vehicle and expect to take a bonus depreciation. Can't do that. And if you happen to buy your sister's Tahoe and use for business, you can't take bonus depreciation either if you buy the vehicle from a related party. But if you buy an ordinary used vehicle, then you can take bonus depreciation. There is another option for vehicles over 6,000 pounds, and that's you can take a $25,000, what they call a 179 deduction. In order to do that, you have to be using that vehicle at least 50%, well, more than 50% for business. But why would you want to do that? Why would you want to take a $25,000 deduction instead of a $50,000 deduction that you paid for the vehicle? Well, that's again, this is another tax question that you need to look at kind of both sides of it. Say, for instance, you had a slow year and you didn't really need a lot of deductions. Maybe you don't want to take that $50,000 deduction. Maybe you'd like to save some of that and spread that out over future years when you might have more revenue that you would want to get those deductions against. So deciding how much to depreciate a vehicle depends a lot on where your business is and where it's going. And those are kinds of decisions that again, tax people can help you make. So it's always a good idea to look at both sides of this and don't just jump and say, oh, let's take the 100%. Sounds like a good deal, and it can be. You can really get if you've had a really good year and you want to buy a new vehicle, now's the time. In order to get that 100%, you have to buy the vehicle in 2022 and have put it into service. Then you start using it for your business in 2022, and then it's qualified. And this bonus depreciation over the next 5 years is going to go away. So next year it's only 80%. The year after that it's 60, 40, 20, and then in 2027 it's gone. So if you're interested in doing that and taking there's things you want to take advantage of that sooner than later. And it's just an idea of some of the larger vehicles that would qualify. So anyways, something to think about. Office at home is another big potential benefit for individual employees. Used to be that if you put an office at home on your tax return, you were just asking for an audit. Fortunately, back in 1999, they passed some new laws and prohibited the IRS from auditing you just because you had a home office on your tax return. They really did use to audit if you had a home office, but now it's not the case, and it's something that you really need to look at if you don't have a regular place of business. So in order to do that, you need to have a place that's regularly and exclusively used for at least one of the following reasons. It's got to be your principal place of business, or it's got to be a place where you meet customers, or it could be a separate structure not attached to your home. Like you got a detached garage with a room over it, use that for an office. You got a shed out and back that you use that for an office. That could be considered a home office. But most of you, I think, are not going to be probably not seeing clients in your home, and you may or may not have an outbuilding. So you're going to need to be making sure that this can be considered your principal place of business. So what does it take to have your home office be considered principal place of business? It's got to be used exclusively and regularly for the administration and management of your business. And you can't have any other fixed location where you conduct those administrative and management things. So you can't have if you got an office or a place where you work out of, and you can't have a home office as well. You got to have one or the other. So what do they mean by regular use? Well, you're going to use part of your home on a continuing basis, and you're going to spend a substantial amount of time working in that home office on a periodic basis. Now, so what does that mean? It's another area that there's all kinds of things like this in the tax code where they're not specifically defined. But if you're working in your home office 1 or 2 hours a week, that's probably not going to cut it. But if you're working a couple hours a day, 2, 3, 4 days a week, that's probably going to meet the regular use criteria. So again, you got to it's one of those things that you need to be using it on a reasonable amount. It can't just be an hour a week or a couple of days a month or something. It doesn't have to be 8 hours a day, 40 days a week, or 40 hours a week rather, but you do need to be using it. And exclusively requires that the space only be used for business. So then it can't have any personal use at any time. The space needs to be separately definable. It doesn't need to be a separate room, but there's got to be a defined space that represents your office. It can be a corner of the living room. It could be a corner of your bedroom, but it's got to be something that's used. If you got a computer, the kids can't play on the computer. It's got to be your business computer. There's a classic example when they used to go out and audit these, they actually would go visit your home and they want to see your home office. IRS goes to visit a woman who has a home business. She's got a bedroom set up. She's got a desk and a computer and file cabinets, and it's all organized for business. And there's a crib over in the corner. They disallowed the home office because it wasn't being used exclusively. So you got to kind of, again, and I'm sure that people sort of play fast and loose with this, but again, in an audit situation, you ultimately want to be as straightforward with this as you can be. So those are the rules: regular use and exclusive use, and then you can claim a home office. Well, what does that do for you? Well, it allows you to deduct a percentage of all the expenses associated with your house: mortgage interest, real estate taxes, insurance, PMI, any repairs, utilities, cleaning, trash removal, condo fees, HOA fees, any of the expenses of your house. If you happen to be renting an apartment, a percentage of the rent can be deducted. So it gives you a nice opportunity for some reasonable deductions. You can also depreciate the house, which can be a substantial additional deduction. Those deductions are based on the reason I say you can take a percentage of these expenses is that you're allowed to take a percentage based on the size of your home office. So you take the square footage of your home office and you divide it by the square footage of your house. So say you got a 500 square foot office and a 2,000 square foot house, you get to deduct 25% of the expenses associated with your home. So it can be a good deal. So even if you only have a 100 square foot office, you still get to deduct something, and it's better than not doing it. There is also what the IRS calls a safe harbor. To the IRS, a safe harbor is a deduction that you don't really have to prove. For instance, everybody gets for this year anyway, you're going to get a single person gets a standard deduction of $12,950 on their taxes just right up front, no questions asked. And that's a safe harbor. They're never going to question that standard deduction. The similar thing exists with home office. You're allowed to deduct up to 300 square feet for your office at $5 a square foot. So no questions asked, you could deduct up to $1,500. But generally, it can be more advantageous to use the actual expenses. Again, this is the kind of thing that you want to go through when somebody's doing your taxes or you're doing your taxes. You want to look at these alternatives, which is the best way to do it. You have the options with this stuff to pick the area that's going to give you the best taxes. You're not obligated to pay the most tax. You're obligated to pay the least tax that the law allows. What's some other benefits of home office? Well, you do get to deduct depreciation. When you sell the house, that depreciation is recaptured. It comes back to you as income, but it's only taxed at capital gains rates. And in general, the amount of tax savings you're going to get from a home office more than outweigh any taxes that you might have due from recovering depreciation. So the depreciation is a good deal. You reduce your taxable business income, so you save on your income tax, and you also save on your self-employment tax. And remember, I said that if you say you leave your home and you're going out to see a client, that the mileage to the first client is considered commuting. Well, if you got a home office, there is no commuting anymore. Every trip that you take away from home is considered a business trip. So that's another nice advantage of a home office, is you get to take larger deductions for mileage expenses. Okay, let's sort of switch gears a little bit and talk about retirement planning. Now, while I think retirement planning is a good deal, as an individual proprietor, sole proprietor, whatever, you need to be looking out for yourself. You're not working for a company that's putting money away or that has set up a retirement plan for you to contribute to. Something you need to do on your own. Unfortunately, 95% of all retired Americans depend on Social Security, relatives, welfare, churches, they didn't really prepare. And that's a big number. Another statistic from SCORE is that only 28% of businesses with less than 10 employees actually have created retirement plans. So it's something to think about. One, it provides you with some money to retire on. But the other thing is it allows you to put away money tax-free until you take it out of the retirement plan. So it can give you some substantial deductions as well as, putting away money for your retirement. There's a number of different plans that have been around for a while. There's one called a SEP, which is a simplified employee pension. Another one called a simple. SEP is kind of like a profit sharing. If you can do it if it's just you. If you've got a few employees, you can provide them. Basically, it sets up an IRA for each employee and allows you as an employer to put money into the IRA for your employees. If you're in the business for yourself, you can set up that IRA and the business can make those contributions to you as well. And those contributions that the employer puts into a retirement plan are deductible as a business expense. So you get to take those off of your business profit, which reduces your business income tax and your self-employment tax. So you get a little extra business benefit from that. Simple plans and Keogh plans are similar. They can be based on IRAs or 401ks, and they allow the employees to make a voluntary contribution and the employer to put in something that matches it. So it's a little different, but the same idea. One I really wanted to talk about is what's called a solo 401k. It's a 401k that you can set up as an individual. And I think it's a powerful plan for individual employers, individual business owners. And it has some nice benefits. One, it allows you to put away the maximum amount of money. And there's some nice features about being able to get that money out. So let's talk a little bit about what that 401k does. So obviously it allows you to make contributions that are tax deductible. So you don't need to pay income tax on that money until it's taken out as a retirement. You get to put away 25% of your net self-employment income, plus you can make an elective deferral and put away up to another $20,500 of your own of non-business personal money into it. And if you're over 50, you can put in another $6,500. So it allows you to put away tax deferred up to $61,000 a year. Actually, $67,500 if you're over 50. So it gives you a substantial way to put away money. If you had a really good year and you've got a bunch of money and you don't want to pay tax on it, you want to put it in a retirement plan, this is a good way to do it. The reason I like these plans is because, one, they're federally protected against bankruptcy. If you have to end up declaring bankruptcy, they can't touch this. It's also protected here in Florida from creditors in the event of a bankruptcy. It has the largest contribution limits, but it allows you to borrow from it. A lot of other plans, if you borrow or take money out of them, it ends up being taxable and you end up paying penalties. This allows you to borrow for terms of, depending on how it's set up, from 5 to 15 years. There's no penalties and no income tax for doing that. You have to pay it back though, and you have to pay yourself interest, but the interest goes back into the account. So you're basically paying yourself back and paying yourself back interest. You're allowed, as with most of these plans, to contribute up until October 15th. Normally, you would put the money in by April 15th, the due date of the tax return, and then you would deduct it from your taxes. But you're allowed to wait until you can get a 6-month extension and wait till October 15th to file your taxes and actually then make this contribution. So you had a bad year and you didn't, at the end of 2022, and you didn't have the money that you wanted to put away, but you can save up, you can take the deduction, you can save up and make that contribution later in the 2023. So it gives you that kind of an option. But I like the ability to be able to take money out if something happens in your business or your personal life and you need to get your hands on that money. It's available without taking a penalty. You know, for instance, say you got an IRA, a SEP base, you're gonna borrow $10,000. Well, right off the bat, if you're in a 25% tax bracket, you're gonna pay $2,500 in taxes, and there's going to be another 10% penalty if you're not old enough for taking that money out early. So you started off borrowing 10,000, you only end up with 6,500 or less, depending on your tax rate. That you actually have money to use. But if you got a solo 401k, you're not paying any taxes up front. You get the whole $10,000, and when you put it back, you've actually put back the amount plus interest. So I like that feature. I know some real estate people use this a fair amount too, because they come across a deal where they want to buy a piece of property and they need some upfront money. They can take it out of this. Once they flip a house or close a deal, they put the money back in, pay some interest, and they've always got this money that they got their hands on. So it can be useful throughout the course of your business. Most of these loans allow you to borrow up to 50K or 50% of what you got in it. So you could take out a substantial amount and have that available. So I like this solo 401k. I think it allows you to have a retirement plan and to get some substantial deductions and to still kind of have access to that money, all of which I think are useful for small businesses. So let's talk for a few minutes about business entities. This is always confusing to people. A lot of people have an LLC, but the only thing that the federal government recognizes from a tax perspective is a C corporation. That's a big stock corporation. You know, General Motors is a C corporation. S corporations, which are simplified corporations, partnerships, and sole proprietors. Those are the only things that the IRS recognizes. LLC is not a federal function, it's a state entity. So if you have an LLC, you have to decide how you want that to report your taxes on that business. So you have to elect to be treated as a corporation, a partnership, a sole proprietor, depending on the nature of the business. If there's two of you together, you can't obviously file as a sole proprietor. It can only be one person. If there's two of you together, you might file as a partnership, or you might file as an S corporation. There can be multiple members in an S corporation. Can also just have one member in an S corporation. So as a individual proprietor, more than likely you're looking at the choice of a sole proprietorship or an S corporation. So we're going to talk about those two things. Sole proprietor, obviously, it's a business owned by one person. The owner carries any liability. The two basic things about business entities: there's a legal aspects of it, and there are tax aspects to it. Your two best friends in business are your lawyer and your tax guy. And you really ought to have both. I know people don't like to spend the money on that, but to get answers to these kinds of questions, the best thing to do is to talk to professionals who can help you make these decisions. So as an individual sole proprietor, you really have unlimited liability. Anything, you and the business are one thing. So anything that goes on, somebody sues you as a result of something you did in your business, all of your personal assets are available to them. Sole proprietor is easy. You just decide one day you want to be in business and you start a business. You decide one day you want to end your business, you end your business. There's no filing or paperwork to file to be a sole proprietor. But again, like I said, your personal finances and your business finances are one and the same. So S corporations, they're a little different. You can have up to 100 members in an S corporation. There are some restrictions to people that can be members. For instance, a non-resident alien can't be a member of an S corporation. But S corporations are different. The income and losses from the corporation are not taxed federally. So there's no corporate tax on an S corporation like there is for a C corporation. And any gains or losses pass through to your personal tax return, and that's how things get taxed. So there's a difference there. So S corp versus sole proprietor. Well, as a sole proprietor, you don't pay yourself a salary. You and the business are one together. Any of your net, well, all of your net business income is subject to self-employment tax, which is 15.3%. And when you file your taxes, there is no separate business return. You file a personal tax return, and there's just a Schedule C attached. That's for your sole proprietorship. With an S corporation, you have to pay yourself a reasonable salary. And a lot of people set up S corporations and they don't do that. That's not correct. You have to pay yourself a reasonable salary. So if you're making $100,000, if you're taking in $100,000 a year in your business, you can't pay yourself $10 a month. It's got to be something reasonable for the type of business that you're in. And with that reasonable salary, you have to be paying withholding, you have to be paying Social Security, Medicare, just like any employer would do for an employee. And you're going to issue yourself a W-2. So that's some things that you have to do. You also have to file a separate S corporation tax return. And any of the gains or losses from the business are going to come to your personal return on what's called a Schedule K1. So the question is, which one of these would be better for you? Why would you want to do one over the other? Well, the real saving comes about largely in terms of your self-employment tax. As a sole proprietor, you're paying self-employment tax on all of your business income. And you pay that both as income tax and SE tax. You pay that tax as part of your personal return. In an S corporation, you only pay an SE tax on the salary that you paid yourself. Any of the other income from your business that passes to your personal tax on the K1 isn't subject to self-employment tax. So you're saving 15%. So by having some of that money subject to self-employment tax and some of it not, can potentially give you a substantial saving on that self-employment tax. But the other side, there's some other expenses associated with that. And so you got to kind of look at all the dimensions. You have to pay yourself, you got to make quarterly payroll filings and pay withholding and FICA. You usually need to have somebody do that for you. You've got to file an S Corp tax return, an 1120S tax return. And there's not a lot of software around that lets you do that yourself. And you've got to then file a personal tax return. So there's some additional expenses related to actually having an S corporation in terms of the returns that you have to file and the work that you've got to do. So you got to kind of look at all those dimensions of the S corp versus the sole proprietor and see which one gives you the best advantage. The best way to do that is to have somebody help you out and to do what's called a pro forma tax return. Try your tax return as a sole proprietor, try it as an S corporation, and see which one seems to be the advantage. And if you decide that being an S corporation is the best thing, then you have to you have to set up a corporation and apply to the IRS to make that an S corporation. And those are all things that somebody in the tax business can help you do. That's why I say the tax guy is going to be your best friend. So we talked a lot about deductions. Well, deductions help you. Like I said, they're going to reduce your taxable income, which for many, business people, that's your net business and net employment business, net business income rather. For instance, if you're a single person, any dollar you make over $41,776 is taxed at 22%, and another 15.3% for self-employment tax. So you're getting taxed 40.3% on that money. So every dollar that you can save by using deductions is saving you a substantial amount of tax. So it's important to kind of understand the deductions that you can take, to take them correctly. But like I said, you're allowed to take all the deductions that you're legally entitled to, and you're allowed to legally reduce your tax as much as possible. And IRS doesn't expect you to pay, like I said, it doesn't expect you to pay the maximum tax. They expect you to pay the minimum amount that you're legally allowed to pay. So, you know, being self-employed or as a single proprietor, nobody's putting away any withholding for you. They're not doing anything to help you pay your taxes during the year. But in reality, you're required to be paying tax throughout the year. You can't wait till the end of the year and pay all your tax. You're going to get a penalty for underpayment. So the rule is this: by April 15th, you have to have paid enough in taxes that was equivalent to 100% of the tax you paid last year, or 90% of the tax that you owe this year, or owe less than $1,000. If you meet one of those criteria, you'll pay the balance with your tax return on April 15th, but you won't get any underpayment penalties. If you haven't paid those amounts, then you can get stuck with an underpayment penalty based on what you owed. Now they call these quarterly estimated tax payments. The dates are kind of funny. First one's due on April 15th, then March, then June, September, and January of the following year. So they're not exactly quarterly, but that's when these payments are due. So again, you can work with a tax person, estimate how much maybe you're going to make next year, do a pro forma tax return and get an estimate of how much you think you're going to make next year, figure out how to make quarterly tax payments to make sure that you've covered the majority of your taxes by time to file. And even if you pay, but you pay late, you pay after these dates, you can still get an underpayment penalty. So it's important to make estimated payments and to make them in a timely way. Record keeping, I always harp on all of this, but we've had a number of discussions already about keeping records. Keep all those receipts, keep the paper receipts. In a lot of cases, a credit card receipt, a check, something in your bank statement says you spent $400 at Home Depot. That's not good enough to prove that that's a business expense. You're going to need the actual receipt that shows what you bought and ultimately justify that that was a business expense. So the best thing you can do is to make sure you're keeping receipts. How long do you got to keep supporting documents? Well, the IRS can audit you for up to 3 years. I always suggest that you keep stuff probably in 5 years just in case. If you've got equipment that you've bought, capital equipment, and say you're going to depreciate it over 7 years, you should keep the documents relative to that asset for 7 years. So if you got any capital assets, you want to keep documentation on those assets as long as you've got the asset. I've mentioned this a bunch of times. Why would you want to hire a paid tax preparer? Well, first of all, there's 60,000 pages in the tax code, changes all the time, gets bigger all the time, changes frequently. And basically, your tax time is way too valuable to be screwing around trying to make these decisions or worrying about your quarterly tax filings if you set up an S corporation. You want to get some help, and help is always available. It's not super expensive. It's something that you ought to be doing. Here's one of my favorite quotes from Albert Einstein, who notoriously didn't understand his taxes. The hardest thing in the world is to understand is the income tax. That was a quote from him. Back in his day, the IRS used to send you out a blank tax form and you'd mail it back with your taxes. Of course, they don't do that anymore. But he would send back the blank tax form with a note that said, just tell me what I owe, because he didn't want to bother trying to figure it out. So having some tax help is a good idea. All right. Have some time. We got a few minutes for questions. You can put them in the question or put them in chat, either one. If you got some questions, I can try and answer. I know it's a lot of information. It kind of goes by quick, but anything that you've done or have done in the past, or anything you got questions about, just let me know. Okay, well, don't see any questions. Appreciate everybody attending, and thanks very much. I hope you got something out of this. Again, if you need some help with your business, don't be afraid to go to our website, pascofernando.score.org, or to the national website, score.org, and request a mentor. And you will get assigned somebody that you'll find is going to be very helpful in your business. So thanks a lot for attending. You guys have a great day.